Welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we have made an incredible turnaround here from last week when we were speaking, where things looked far more dire with regards to equity markets and whether or not any potential bounces in the equity markets were going to have any legs. And a week later, we have equity markets breaking out above major resistance levels multiple times over across all the major indices, giving us a far more bullish kind of signal on the recovery from the sell-off, very much a V-shaped sell-off, which statistically speaking, doesn't happen very often. Doesn't mean that things can't pause and start turning back around again. But overall, we've seen a lot of strength here on the recovery. 8 out of the last trading sessions have been all positive here on the S&P 500, which is an incredibly rare statistic. For those of you that do follow things like sequential counts and things like that. So overall picture looks far more improved from last week. So let's take a look at kind of where the overall charts stand and what our views here are going forward. So the S&P 500, we talked about the fact that the 50-day moving average is a level of resistance that we would come up across on the recovery. You have 55.70, which was the prior highs. We've broken out above that. We really just have the all-time highs as the last level of potential resistance here on this overall recovery that could, see prices pause a little bit at these specific levels. And I think, we might come in to touch those all-time highs here over the next couple of trading sessions. And perhaps at that point, we see a little bit of a pause here on the overall rally. We really want to see how do prices respond to that specific level. Does it break through and continue moving on? Does it take a pause? But overall, the picture, like I said from a couple of weeks ago, far improved and far better than I think what a lot of people were expecting a bounce would sustain here on the S&P 500. We see it on the NASDAQ 100 as well. We broke above the 50-day moving average and 475 resistance level here, so it's broken out above that. We still have some minor resistance here around 485, and then you have your all-time highs. Those are kind of your two last remaining, your last two remaining resistance levels here for the NASDAQ 100. You have small caps, Russell 2000, that's broken out above 210 as your resistance level, which starts to target the 225 all-time highs here to the upside on IWM, and then RSP. As you can see, RSP within spitting distance of breaking back above all-time highs. That would be a pretty strong bullish signal if you have the S&P making new all-time highs and the equal weight S&P 500 index also making new all-time highs. That would be something that we haven't seen in quite some time. These two indices making all-time highs together. But if they do, that would be also a pretty bullish signal here that we're getting from equities overall. Like I said, big turnaround from a couple of weeks ago, far better than I think a lot of people were anticipating any bounces were going to sustain. On the bounce here over the last couple of weeks, we have seen growth outperform value in that particular instance, which is along the lines of the long-term trend that we see here. The question is also whether or not that continues here this week. We'll talk a little bit about sector rotation here and the fact that there really is a lack of rotation at the moment. You really have technology leading the markets higher while the rest of the markets are being sort of left behind a little bit, which is something to be concerned about. So we'll continue to monitor that and see how the different sectors are responding to this rally here at the moment. You have commodities. You have gold making new all-time highs, but as you can see, commodities overall remains sort of soft and a bit challenged here. We have oil prices kind of back to near one-year lows. So that's been contributing to kind of the softness here that you see across the board in terms of commodities and other assets, other commodities itself, with the exception of gold and silver, kind of making new highs. Um, Taking a look at high yield corporate bonds ETF continues to make new relative highs. This is certainly a overall positive or risk on signal here for the equity markets to see to see high yield bonds continue to rally. You see the bond markets continue to price in, a fairly calm market with regards to credit risk. So not overly concerned with regards to risk here that we're seeing from the bond markets. VIX, big round trip here. We're at about under 15% here. We had this huge spike in terms of VIX. We're back below 15%. As I was saying before, kind of these V-shaped recoveries, effectively what is a spike in VIX, like a single day spike in VIX, and then comes right back to kind of normal levels. Incredibly rare in terms of occurrences in history, but largely that is what we're seeing here right now. 10-year yields continue to kind of decline a little bit. We're here around 3.8%. Right now, the bond markets are pricing in a nearly 50-50 coin flip between 75 basis points and 100 basis points in terms of rate cuts here for the rest of this year. Now, Jackson Hole kicks off this Thursday. So there's a lot of eyeballs on kind of central bank policy with regards to expectations. We certainly have already seen a couple of central banks around the world start to cut rates. Our expectation, obviously, is for the Fed to cut rates at their September meeting for 25 basis points. So outlook of rate cut expectations is also something that's heavily weighed into how we're thinking about equities from a valuation perspective as well. TLT broke out above this $94 level, continues to be constructive here for further upside here for TLT. The dollar index did manage to break below this 102 support level that we were talking about. The fact that we broke below it starts to target 100 here to the downside on the US dollar with lower rates. Expectation for further weakness in the US dollar is expected. Gold, as I was saying before, we have gold breaking out to new all-time highs, 2540 on gold futures contracts. This 2450 resistance level so far has been cracked. We've broken above it multiple times, and now we've sustained ourselves above that level and made our way to new all-time highs. This could be a bit of a slow grind here, but the upside target for gold is 2750. If you look at kind of the trading range, the consolidation that we've been in versus the size of the move that we had prior to the consolidation, and now we've broken out here to the upside. That would target 2750 here to the upside for gold futures contracts. You have oil kind of pulling back into the $74 level here. Pulling back into the $74 level starts to get to levels that we typically would be more comfortable being buyers in terms of oil. So, 72 would be kind of that level that we've seen multiple attempts at 72 as potential buying opportunities, and we're just within spitting distance of that specific level. If we break below 72, that would certainly speak to one, softness in terms of demand, but also perhaps a bit of a pullback in terms of concerns around geopolitical tensions here in the Middle East. Because right now, this is a two-sided equation right now with regards to supply and demand. Demand obviously starting to be a little softer here, especially as we see economic data start to slow down. We see surprises more so to the downside than we do see to the upside. Despite here in the US, we're actually seeing some pretty big surprises to the upside over the past couple of weeks, but globally, A bit of slowdown in terms of economic data leads us to believe that demand will be softer, but at the same time, supply seems quite robust at the moment with regards to number of barrels being extracted out of the ground and inventory as well. So looking at the overall sectors, this is really where kind of overall when we looked at the charts across the board up until now, it's been incredibly positive for the equity markets. When we start diving into sectors, this is one of the areas where things uh, not that they don't look as bright, but there are some concerns that start to play out here. The concerns with regards to um, some of the um, with regards to the sector rotation, or rather lack of the sector rotation. Um, you have technology that has really kind of led this market higher here. We've gotten back to the 50-day moving average and managed to punch through above that. And you see the strong relative outperformance of technology to the S&P 500. But then when you look at all of the other sectors, you look at consumer discretionary, you see the fact that consumer discretionary continue to lag behind the overall markets. From a relative performance perspective, you have communications that has failed to kind of get back to these all-time highs and is starting to underperform the overall market. You have financials that are starting to underperform the overall market. We are at this triple top, so that is constructive here if we break out above that. However, the concern still is the fact that the relative performance is not there, as sectors like consumer staples, financials, communications kind of test recent highs with regards to expectations of um, for relative of these specific sectors when you look at the relative performance, right? So all of these sectors on paper, if you just look at the absolute chart, it looks constructive, but if you look at the relative chart to the S&P 500, they're all falling behind. And what that means is that you really have a fairly narrow rally here right now. You really just have technology lifting the markets higher versus every other sector that we've looked at so far: industrials, materials, real estate, energy, utilities. Every single one of them underperforming the S&P 500. So that is definitely one of the areas of this recovery that is concerning when you only have one sector leading the markets higher. That's not healthy at all. The further that goes, the more likely you get these violent sell-offs that are kind of almost impossible to predict and very difficult to trade. You end up many times getting caught on the wrong side of that. Chasing stocks higher and then only for them to collapse very, very quickly, and then kind of being left to pick up the pieces. When you have markets that are narrow, they lead to those types of market conditions that kind of led to the sell-off that we had a few weeks ago. So that is the one thing that I do think is important to be aware of on this overall recovery, is the risk with that kind of recovery. It's not a recovery that's broad-based. It's kind of seeing a lot of different sectors kind of being bought up, or rotation is you just have one sector that's leading the markets higher here. XHB, Home Builders ETF, continues to show a little bit of weakness here on the recovery, and semiconductors overall showing relative strength. But I do want to point out here, semiconductors nowhere near recent highs, right? If you look at all of the other sectors, we're pretty much near recent highs or all-time highs. Semiconductors nowhere near there, and that really kind of leads me to believe that semis, not the same strength, not the same hype, not the same demand for semiconductors on the recovery as we have seen in the past, which could also lead us to some clues with regards to this overall recovery. So overall, things quite positive here. But the sector rotation is certainly one area that is concerning, that I think is important to pay attention to here right now. So with that, what I want to do is I want to leave you with a couple of ideas here for today. Nike, first of all, is one that I think was worth looking at. Nike broke out above this $80 resistance level here, which kind of starts to put this low 90 gap fill into play here. Nike obviously on earnings disappointed, managed to get back above that $80 resistance level here and starts to potentially fill this gap here in the low 90s. Another one on the upside here is Cisco. As you can see, you have this long-term downtrend in Cisco that has recently broken out here to the upside. In terms of earnings, we've seen a good amount of momentum here. It's punched through a couple of resistance levels here as well, around 49.50. This starts to put the low 50s into play. You have this level here around 52, that's kind of your next level of resistance. Then you also have a gap fill level here in the $53, $54 area here that can provide some upside targets here as well for Cisco. On the flip side, we also have PayPal, another one to take a look at here, recently breaking out above the $68 level here to the upside. PayPal has been a stock that's been on our radar since earlier this year, worth paying attention to right now as well. So within the semiconductor space, we see a lot of opportunities that are similar to this. These are semiconductor stocks that have recovered a bit, but kind of recovered back to major resistance levels where the risk reward potentially starts favoring a bit here to the downside, as some of these semiconductor stocks are trading at pretty rich valuations. A lot of charts look very similar to applied materials where the recovery overall isn't as strong, and has propensity to potentially start to see some declines here to the downside. See the same thing in things like Robinhood, some similar type chart. You see the breakdown here, recover back to resistance level, potentially a bearish candidate here as well. And lastly, I'll leave you with Oracle, similar type chart, breakdown, came back to retest this resistance, potentially bearish candidate here as well. That kind of leaves you with the overall outlook here for the week. Largely very positive. Some concerns that we'll continue to monitor here over the next couple of weeks, and leaving you with a few ideas to start off your week. With that, thank you so much. I hope you guys have a great trading week, and I'll see you guys tomorrow at noon for our next options education session. Thank you so much and have a great trading day.